AbbVie just beat consensus by 10 cents. I mean, they pulled off one of the most difficult magic tricks in the pharmaceutical industry today by printing a clean 10 cents of overperformance.
Right. And they didn't do it by clinging to the past either.
No, exactly. They basically proved their legacy powerhouse is officially obsolete. So we are looking at a fundamentally strong Q2 report. Let's just get right into the headline print for you.
Yeah, hit the numbers.
So revenue came in at $16.99 billion for the second quarter.
Which is an increase of 10.2% on a reported basis.
Yep, 10.2%. And adjusted diluted EPS hit $3.65.
Yep.
That is a massive 22.9% increase year over year.
Wow.
And you should note that adjusted EPS figure actually includes a 17-cent hit from acquired in-process R&D and milestone expenses.
Right.
So without that, the beat is even wider.
Yeah, that's a huge detail. And the GAAP EPS.
GAAP EPS came in at $2.03. Looking forward, management updated their full-year 2026 adjusted EPS guidance to a range of $13.87 to $14.07.
Right.
And a quick note for you, because we are operating strictly off the raw earnings release provided in our sources, we don't have the livestock ticker reaction in front of us. But, I mean, a fundamental print like this points squarely to a strong beat.
Absolutely. So to give you a sense of our mission for this deep dive today, we're pulling from a pretty big stack of sources.
Yeah, the raw earnings release, management's prepared commentary, the supplementary financial tables.
Right, and their updated clinical pipeline reports. We are really going to peel back these headline numbers to understand exactly how AbbVie engineered this quarter. We'll analyze the segment-by-segment performance, unpack the margin profile, and, most importantly, evaluate if their aggressive multi-billion-dollar acquisition strategy is actually smart capital allocation for retail investors.
Or just a sign of defensive desperation.
Exactly. Because looking at top-line revenue growth is one thing, but tracking where management is deploying that capital tells you what they actually believe about their future.
Which brings us perfectly to the guidance math. Because it presents this fascinating paradox right out of the gate.
Oh, the guidance contraction.
Yeah. We just mentioned they updated their 2026 guidance to that 1387 to 1407 range.
Why?
But if they just printed 10 cents of operational overperformance this quarter, why did the midpoint of their full-year guidance technically drop by 4 cents from the previous range?
Right. It looks super weird.
I mean, normally when retail investors see an earnings beat paired with a guidance midpoint contraction, it sets off massive alarm bells.
Sure, it looks contradictory on the surface, but the underlying math reveals a deliberate structural shift rather than any real operational weakness.
Okay, walk us through it.
So the contraction is entirely driven by their capital allocation. AbbVie is taking a 14-cent dilutive hit to their 2026 earnings to fund the proposed acquisition of AbbVie Therapeutics. Ah, okay.
When you take that 14-cent headwind from the M&A activity and partially offset it with the 10 cents of operational overperformance they just generated this quarter, you net out to that exact 4-cent reduction at the midpoint of the guidance.
Got it. So they are intentionally diluting near-term earnings to buy pipeline assets.
Exactly.
They are essentially taking a near-term margin hit to buy future growth. But, let's scrutinize that purchase a bit. They are paying $10.9 billion for AbbVie's clinical stage candidates.
Right. The standout assets here being zumilokibart, which is known in the pipeline as APG-777 for atopic dermatitis and APG-273 for asthma.
And this is where I have to push back on management strategy. An $11 billion price tag is a massive premium for pipeline assets that still carry significant clinical trial risks.
Yeah, that's not cheap. I mean, we all know phase 3 trials fail constantly. It's like paying a huge cover charge to get into an exclusive club before you even know if they have the drinks you want. Is this a confident expansion? Or is management just aggressively trying to buy mega blockbuster growth because they're terrified of their older drugs falling off a cliff?
Well, I wouldn't frame it as terror, honestly. I would frame it as aggressive pathway consolidation.
Pathway consolidation.
Yeah. If you look at CEO Robert A. Michael's commentary in the release, he anchors this quarter's success on outstanding execution and pipeline advancement. The AbbVie deal is fundamentally about cementing absolute dominance in immunology.
Okay.
So AbbVie's pipeline targets the IL-13 and TSLP pathways. To understand why that matters, you have to look at the mechanism of action. These are cytokines, essentially the the chemical messengers that trigger your immune system to overreact and cause severe inflammation in conditions like atopic dermatitis or asthma.
Right, so blocking those specific pathways halts the inflammatory cascade at its source.
Exactly. And AbbVie already has an incredible commercial infrastructure for selling immunological drugs. They don't just want a piece of the market, they want to own the entire spectrum of inflammatory treatments.
And you really cannot fully grasp why they would pay an $11 billion premium for unproven immunological assets until you look at what happens when they actually own a dominant pathway.
Yeah, the proof is right there in the current segment performance.
It really is. The existing immunology segment completely crushed it this quarter, up 15.1% to $8.786 billion.
Those numbers are just massive.
Their two new flagship drugs are operating at an astonishing scale. I mean, Skyrizi generated $5.505 billion, growing at 24.4%.
Over $5 billion in a single quarter.
And Rinvoq hit $2.525 billion, growing at 24.5%.
Maintaining mid-20s percentage growth on a base of $5.5 billion in a single quarter is almost unheard of in this sector.
It's crazy.
It requires a relentless expansion of your target patient population to keep that up.
Which makes the contrast with their legacy powerhouse, Humira, so fascinating to me. Humira is down 35.9% globally, bringing in just $756 million.
Right.
I mean, Humira used to be the undisputed king of the pharmaceutical world. Now it generates a fraction of what Skyrizi brings in. It feels like watching a massive tech company successfully migrate millions of enterprise users from a legacy on-premise software platform to a new cloud subscription right before the legacy servers get shut down by competitors.
That's a really good way to look at it.
So, does this quarter finally prove the Humira patent cliff is completely in the rearview mirror?
I mean, the operational data absolutely confirms a successful transition. For the last half-decade, the Humira patent cliff was viewed as this existential threat to the company.
Oh yeah, everybody was terrified of it.
The market just feared that cheap biosimilars would erode Humira's market share far faster than any new pipeline drug could replace lost revenue. But they engineered an incredibly soft landing.
And the mechanism behind that success is total addressable market, or TAM, expansion, right?
Exactly. Skyrizi and Rinvoq are not just cannibalizing old Humira patients, they are securing entirely new therapeutic indications.
Yeah, the regulatory milestones in this quarter's report really highlight that label expansion. We see Skyrizi getting FDA and European Commission approval for treating children 6 years and older with moderate to severe plaque psoriasis, along with pediatric psoriatic arthritis.
Right.
And Rinvoq secured EU approval for non-segmental vitiligo and severe alopecia areata.
And those specific approvals, they tell a deeper scientific story. Vitiligo is an autoimmune condition where the body attacks its own pigment-producing melanocytes, and alopecia involves the immune system attacking hair follicles.
Okay.
By gaining approvals for these conditions, AbbVie is proving that their drugs are highly effective systemic immune modulators, not just specialized treatments for a single type of joint or skin inflammation.
Oh, I see.
Yeah, so expanding the label across diverse autoimmune disorders vastly increases the patient pool. The 36% decline of Humira, which, by the way, management entirely expected and modeled for, is being easily absorbed by the sheer volume of new patient populations gaining access to the newer flagships.
But you mentioned earlier how expensive it is to fund these massive multi-indication clinical trials.
Oh, yeah, it's definitely not cheap.
Right. That level of R&D isn't free. And when we look at the financial tables, there is a specific segment funding this entire operation. While immunology gets the flashy headlines and the $11 billion M&A deals, the neuroscience division is quietly operating like a highly profitable secret venture capital arm inside the company.
It really is.
It's actually growing faster on a percentage basis than immunology.
The neuroscience numbers are remarkable. Revenues jumped 20.3% to $8 billion this quarter.
Wow.
Vraylar broke the billion-dollar mark for a single quarter, coming in at $1.071 billion, which is an 18.9% increase. Botox Therapeutic pulled in $1.042 billion.
And the migraine portfolio is doing well too, right?
Yeah, it's accelerating rapidly. Qulipta saw massive 30.9% growth to hit $350 million.
What really stands out to me is the underlying business model of these neurological drugs. When you look at a psychiatric treatment like Vraylar or a chronic migraine preventative like Qulipta, which the report notes just got EU approval under the brand name Aquipta for acute migraine treatment, These are incredibly sticky revenues.
Oh, absolutely. The retention rates in this space define the financial profile.
Yeah.
The patient journey for complex neurological or psychiatric conditions is notoriously difficult. Patients often spend years cycling through different medications with severe side effects before finding a molecule that actually stabilizes their condition.
Right. And once they find it, they stick with it.
Exactly. Once a patient finds a treatment that works, whether it's Vraylar for bipolar depression or Botox for severe spasticity, they do not want to switch. This creates a recurring, subscription-like revenue stream that is highly predictable and insulated from sudden market shocks.
And that predictability flows straight down to the profitability metrics, which look more like an enterprise software company than a traditional manufacturer of physical goods.
For sure.
Adjusted gross margin sits at an incredibly high 84.7%. Adjusted operating margin is 48.3%.
Yeah, and those margins represent the core engine of their long-term strategy.
Yeah.
You take those sticky, extremely high-margin cash flows from neuroscience and immunology, and you use them to bankroll the massive high-risk bets required for future growth.
Right, the pipeline investments.
The R&D spend in this report proves it. They ran their research and development engine at 13.6% of net revenues this quarter. That equates to $2.4 billion spent on R&D in just 90 days.
That is wild.
Yeah. The pharmaceutical company can only sustain that aggressive level of pipeline investment if their core commercial assets are churning out near 50% operating margins.
But to maintain our objectivity here, we have to flip the coin and look at the segments that are dragging down those margins. Not everything on this balance sheet was up 20% this quarter.
Sure.
Let's look at oncology. Revenue there actually shrank by 1.5% to $1.60 billion. That contraction was driven heavily by Imbruvica, which plummeted 29.4% to $532 million.
Right.
And aesthetics is essentially flat, up just 0.3% to $1.2 billion, with Juvederm dropping 6%. So looking at these numbers, I just have to ask, is management neglecting oncology?
Well,
I mean, if Imbruvica is losing nearly a third of its revenue year over year, why are they spending $11 billion acquiring immunology assets like AbbVie instead of deploying that capital to rescue their blood cancer portfolio?
so it is a fair critique of their capital deployment. But viewing oncology as a neglected segment ignores the technological transition happening beneath the surface.
What do you mean?
Imbruvica's decline is steep, but it's not due to a sudden lack of efficacy. It's facing intense structural competitive pressure from next-generation BTK inhibitors. Management isn't trying to artificially prop up a declining legacy asset.
So they're letting it fade.
Basically. Instead, they are redirecting their oncology R&D toward entirely new modalities. You can see the early results of that shift in Elahere, which was up 33.1% to $211 million.
And the clinical updates in the report definitely highlight a pivot in their oncology strategy. I mean, they announced FDA approval for Dectopaz this quarter.
Yeah, and Decnupaz is a crucial milestone because it is their first antibody-drug conjugate, or ADC, approved for a blood cancer.
Okay, an ADC.
Right. In this case, it's approved for an ultra-rare aggressive malignancy called BPDCN. The mechanism behind an ADC is entirely different from older targeted therapies.
Also,
You can think of an ADC as a... Exactly. The top-line segment number looks slightly negative right now because the sheer financial weight of Imbruvica's decline masks the rapid growth of these newer, highly complex therapies. They aren't ignoring oncology. They just recognize that the AbbVie acquisition presented a rare opportunity to secure generational dominance in a space where they already possess unmatched commercial leverage.
but transitioning a portfolio to next-generation modalities is inherently risky, which brings us to the forward-looking risk factors management disclosed in the report. This is not a risk-free environment, and the stakes for capital allocation are getting higher.
Oh, for sure. The most immediate internal risk centers squarely on the execution of the AbbVie integration. They are paying a massive $10.9 billion premium based heavily on the future potential of early-stage drugs like APG-777.
Which are still in trials.
Right. The report explicitly highlights the risk that these pipeline assets may fail to demonstrate the anticipated safety or efficacy in large-scale clinical trials. In the pharmaceutical industry, Phase 3 trials are notoriously unforgiving.
Oh yeah, they are brutal.
If APG-777 fails to hit its primary endpoints in late-stage testing, that $10.9 billion valuation instantly becomes a catastrophic misallocation of shareholder capital.
And the report also outlines significant external threats, specifically broader macroeconomic factors. They cite international conflicts, trade disputes, and potential terrorist structures.
Which is standard, but important.
Yeah, I mean, when you are a global enterprise generating over $4 billion in international revenue in a single quarter, global supply chain disruptions and shifting trade policies become very real threats to sustaining an 84% gross margin.
Geopolitical friction directly impacts cost of goods sold. When your entire financial model relies on throwing off massive free cash flow to fund a multi-billion-dollar R&D and M&A, any macroeconomic pressure that compresses your gross margin inherently threatens your ability to fund the future pipeline.
Right. So to bring all this together for you, AbbVie is demonstrating incredible operational momentum. They have successfully bridged one of the most feared patent cliffs in medical history, replacing Humira's dominance with explosive, label-expanding growth from Skyrizi and Rinvoq.
Absolutely.
And they are utilizing the highly predictable, sticky cash flows from their neuroscience division to quietly fund massive internal R&D across both immunology and next-generation oncology therapies. But the financial stakes of maintaining this growth rate are escalating, as evidenced by the $11 billion AbbVie deal.
Which leaves us with a critical question to evaluate over the coming quarters. Management has proven they can execute an incredibly difficult transition by leaning heavily into the clinical success of Skyrizi and Rinvoq. But with this $10.9 billion bet on AbbVie, they are essentially attempting to run that exact same playbook for the next decade. The ultimate question for retail investors is whether a pharmaceutical giant can engineer lightning to strike twice just by buying the right biotech pipeline, or if the sheer law of large numbers will eventually force their growth to stall.
That is the defining question for anyone holding the stock or watching this sector. Thank you for joining us as we unpack the fundamental print today. Make sure to subscribe and follow the show for daily, no-nonsense earnings coverage. See you in the next deep dive.